headline. But I'll quickly switch focus. Suvankar Sen, Managing Director and CEO at Senco Gold, joins us. Now, the numbers were slightly on the weaker side, Suvankar, and it came as a bit of a surprise for the street as well, because you had a couple of tailwinds. Of course, gold prices came off, but what we saw was that you had that duty on gold, which was hiked from 6 to 16%. Talk to us about what's happened on margins, Suvankar, because I think that's where the larger concern of the street currently resides.
If you've seen the results, there was a 67% growth overall. And we have, in retail, we've grown by almost 50%. So overall, because the gold prices have been on an upward trend year on year, that has driven in terms of sales performance. The sales were driven largely by the old gold exchange because from the month of May and June, after the duty got increased and there was an appeal by our Honorable Prime Minister where we could, how we could reduce the import of gold. So the consumer sentiments were on the lower side and we wanted to promote old gold exchange in a large manner. And we all know that when we do old gold exchange, usually the margins, there is some kind of an impact. So that was one of the reasons why the margins are on the lower side. We also have seen that if we compare it from an overall guidance perspective, we've always been saying that our PAT percentage should be at about 4.5% for the whole year. And, the EBITDA is about 7.5 to 7.8%. So particularly for this particular quarter, against, the sentiments, the heat wave, overall the sales, April had been a phenomenal month, but May and June has been comparatively lower. So we have done our bit of driving the consumers to come to the stores, to increase footfalls. And this is what it is. But it really, for us, it's not a worry. We are still very much confident that the 4.5% PAT or a 7.5% on EBITDA is very much in place. We could see a lot of increase in diamond jewelry sales also, which is building up on the overall profitability. And after that 60% growth, if you look at the current performance of July and August as we are speaking, we are growing at about 25% year on year as well, building up for the plan for the upcoming festive season in Q3. So for us, I think that we are positive. And yes, maybe with the 60% plus growth that we saw in top line, people were expecting that the PAT could also grow to that extent. But I see that, this particular quarter was a quarter to really drive the numbers and ensure consumers came in against the negative sentiment. And we've done a good job. And I think we'll continue with our performance of growth, both in terms of profit and in terms of top line as well.
So the 7.5% EBITDA margin, which you're looking to clock for full year, what changes for you, and does it change as early as Q2?
Yes, I think so. Q2 and the bigger jump comes in Q3. So over the coming 4 quarters, you'll always see that there are averaging out happening and the leverages start working in Q3 where the sales go up, but your cost remains under control. So that's going to be very, very important. But yes, I think that in Q2 itself, we'll see some amount of improvement and Q3 also will see a larger improvement. And that's how our 7.5% would continue to remain. Like, see, in terms of stud ratio, there is a lot of new collections, designs coming up with engagement with the consumers are happening. Very recently, if you've seen, we've launched men's jewelry in titanium, which is one of its kind and the first of its kind for the Indian jewelry industry in the organized sector. So we are coming up with innovation and new designs just to make sure that either be the young generation or consumers are continuously attracted towards us as a brand.
And Suvankar, again, if you can try and give us a perspective. One is, of course, studded and the kind of mix that'll likely aid the margin number. But from the kind of base you're currently operating out of in terms of margin, what's the lever there? Because it's not like studded didn't work for you in Q1.
No, studded worked, but it's been at about 11%. So if we take it a little better and make it closer to 12%, that will have a positive impact if you really look at it in that particular manner. Second is that we have about 12, 13 stores in the pipeline that is coming up in Q2. And I think that, those additional stores will help us again with the top line and the bottom line as well. we are aware that in particular Q1, again, I'm reiterating that after the first month of April, May, and June has been challenging. There's a lot of discount schemes that had to be given in order to ensure that the consumers were coming and the footfalls were there. But I can see very much so that Q2, July, August, September, consumer sentiments are improving. People are planning for the upcoming wedding season, and purchases are happening much more smoothly, which I also would feel that yes, it will have its positive impact on the margins as well. So these are your simple levers. You open new stores, you focus on studded ratio, you ensure that you are controlling your schemes, offers, discounts, and I think 7.5% should not be a challenge.
And same-store sales growth, you've done very well on that particular metric. So essentially, Suvankar, is this quarter more of a quarter where you can say you were focused more on volume and value rather than on profitability? You wanted to get the consumer in, you wanted to make the sales required, and maybe hope that repeat consumers come back to you in Q2 and Q3 when the season actually kicks in. Is that broadly the way one thinks of it? Also, give us the volume versus value split, rather just the volume number for Q1.
So I'll tell you that Q1, whenever you begin the year, you must begin it with a bang and have a very positive sentiment at the stores with the team. So you have to, try your level best to engage with the consumers and have a very strong target for your team so that you feel very good for the whole year. So I think that's, you have rightly said that it has been a more of number, volume, and value driven rather than looking at, oh, okay, where am I making more profit, more, or where am I making less profit? Because it's the beginning of the year, you engage with the consumers, and then you wait for the whole year to span out accordingly. And if you look at it, that in terms of value growth versus volume growth, I must tell you that while we have grown 61%, 67% overall in value terms, but in terms of volume, we are down by 2.5%. So what are we looking at? We are looking at creating lighter weight jewelry, which is going to drive the consumers into the stores. We are looking at experimenting with lower caratages, 9, 14, 18 carats, because we need to make jewelry that is fitting into the budget of the consumer. And I must also tell you that this quarter, the team has worked on reducing the number of inventory days. So we have, been optimizing it. We've been doing it for the last 1.5 years to have the right stock, and especially when the gold prices have moved up so much. So that those have been certain areas where we have worked upon on the efficiencies, and we'll soon see the results coming in as the year progresses.
Okay, Suvankar, thank you so much for coming in and speaking to us and giving us that perspective with regard to Q1 numbers.
Thank you.
Well, stock